Welcome to The Explainer. Today, we are diving headfirst into a really common and frankly expensive trap that catches so many businesses in Mexico. It all revolves around something called the PUE invoice. Now, on the surface, it sounds simple, right? But believe me, a tiny misunderstanding here can lead to denied deductions and just a massive financial headache. So let's break down this tax audit trap so you know exactly what's going on.
Okay, let's just get right to the heart of it. Here's the situation. You've done the work, you issue your digital invoice, your CFDI, and you mark it PUE, which stands for Payment in a Single Installment. Simple enough. But what happens if your client pays you on, say, the 2nd of the next month? Have you just violated a tax law? Is your client's deduction now at risk? That is the exact confusion we are going to clear up right now.
So here's our game plan. First, we'll look at how this whole mess usually starts during a tax audit. Then, we're going to dissect the tax authority's point of view. After that, and this is the good part, we'll dig into what the law actually says, use that to build your strongest legal defense, and then wrap it all up by talking about why getting this right is so incredibly important.
All right, let's start at the beginning. Where does the trouble usually kick off? Well, it often starts with something that sounds pretty intense, a vigilancia profunda, or a deep surveillance invitation from the tax authority.
The process itself is almost entirely run by computers. The tax authority's systems are constantly crunching numbers, just comparing the income you declared on your tax returns against the total value of all the invoices you've issued. If it finds any mismatch, any inconsistency at all, boom. That can trigger an alert, and you get that official-looking letter inviting you to clarify your situation.
The source material we're drawing from has this absolutely perfect analogy for this. It says, these automated checks are like giving a basket a turn in the air, betting that its contents won't fall out. Think about that. The system is basically designed with the assumption that if it shakes things up, something is bound to be wrong. It's a really wide net, and it's meant to catch pretty much any potential error. So, the system flags an inconsistency, and now you're officially under the microscope. This is where the real problem starts to take shape, and it all begins with how the tax authority tends to interpret the rules. Let's frame this as the prosecution's case. Okay, just so we're all on the same page, a quick definition. PUE. It stands for Pago en una sola exhibición. When you select this on your invoice, you're just signaling that the whole thing is going to be paid in one lump sum, not in a bunch of smaller payments. And right here, this is where it all goes wrong. The common argument from tax auditors is that if an invoice says POE, then that payment has to be made within the very same calendar month it was issued. So if you send an invoice on the 30th and your client pays you on the 1st of the next month, auditors might try to say nope and disallow their deduction. That creates a massive problem for you and for your client. But wait a minute, is that interpretation actually backed up by the law? Let's switch gears and look at the defense's case. For this part, we're going to ignore assumptions and go straight to the source to see what the law itself has to say. And the foundation of our entire defense really comes straight from Mexico's Constitution. Article 14 lays out this core principle of legal certainty. It says that any formal ruling has to conform to the letter of the law. This is so important. It means an authority can't just invent an obligation out of thin air if it's not explicitly written in the law itself.
So, what does the letter of the law say? Well, Article 29A of the Federal Fiscal Code is crystal clear. It says that when a payment will be made in a single installment, that situation must be indicated on the invoice. Did you catch that? Notice the specific words. The law is telling you how to fill out a form, not dictating when cash has to hit your bank account. The logic here is just a straightforward if-then statement. If the agreement you have is for a single payment, then you're required to state that on the invoice. That's it. The law is regulating the document, not controlling the timing of the actual payment. Okay, so armed with that knowledge, let's build the strongest possible legal defense. It really boils down to 5 key arguments, all grounded firmly in the law. Our defense stands on 5 solid pillars. We'll start by distinguishing the payment method from the actual transaction. We'll talk about why your invoice is legally presumed to be true. Then we'll hit on the freedom of contract, the crucial difference between PUE and deferred payments, and finally, the golden rule, that administrative rules can't just override the law. First up, the payment method you put on an invoice, the PUE, is just a detail. It's an accessory to the main event, which is the operation itself. The sale or the service. A detail on a form doesn't change the substance of your deal. And second, the law actually gives you the benefit of the doubt here. Both the fiscal code and the law of taxpayer rights say your documents are presumed to be accurate and issued in good faith.
Our third argument is a big one: freedom of contract. This is a fundamental right, and it's protected by both the Constitution and the Civil Code. It means that you and your client are free to agree on whatever payment terms work for you. Any interpretation that tries to force that payment into a specific month is basically stepping on that freedom.
Now, you might hear an auditor say, well, if it was paid later, shouldn't it be a deferred payment? But legally, that's not correct. A PUE invoice, even one that gets paid the next month, has certainty. You and your client know the amount, and you know the date it's going to be paid. In legal terms, this is a resolutory condition. The obligation is real and it exists right now. A true deferred payment, or PPD, involves uncertainty. You don't know exactly when it will be paid. That's a totally different legal animal called a suspensive condition.
And here's our final argument, the knockout punch. It's all about hierarchy. Yes, there is a miscellaneous fiscal rule that suggests PUE means payment within the month, but a rule is subordinate to the law. The law it's supposed to be based on, Article 29A, never gave it the power to create this timing requirement. To put it simply, a rule cannot create a burden that the law itself never did. The law always wins.
So we've heard the case for the prosecution and the case for the defense. What's the final verdict? Let's get to the big takeaway and why this legal nitty-gritty actually matters to you and your business. Here it is, the bottom line. The number of articles in Mexico's primary tax laws, we're talking income tax law, VAT law, the fiscal code, that say a PUE invoice must be paid in the same month it was issued is exactly 0. Zilch. It's an obligation that has been created through interpretation, not by the letter of the law. And this brings us to the most important insight of all. A tax is just a consequence of something you did. To really understand the tax part, you first have to understand the nature of the transaction itself. Under regular civil and commercial law, it is your agreement, your contract, that determines the tax effect, not the other way around.
And that leaves us with one last really important question that you should ask yourself. Are your business decisions, your contracts, and your invoicing practices based on a shaky, debatable interpretation from the tax authority? Or are they based on the solid foundation of what the law actually says? Knowing the difference isn't just a good idea. It's your strongest defense.